Paul Oosterhuis is an international tax partner with Skadden Arps. He's an extremely helpful and valuable member of the group, not only because he knows so much about international tax and has been instrumental in drafting this upcoming proposal, but also he's our lifeline to reality to a certain extent. Whenever you put a group of academics in one room, it's important to make sure that at least one person knows about reality out there. Well, Mick Keane, representing the IMF, is also part of the group. I'm very happy that he will be one of the those who will give comments to Paul's presentation. Same goes for Jennifer Bluin, who's a professor at the Wharton School, University of Pennsylvania, and well known also in Europe for her high-level work on international business taxation. And Steve Edge, I think for him it's basically a home game, or I would call it, because he's an expert from one of the major city firms, Slaughter and May, and has been, I think, extremely well present at these conferences. I think we have met over the years several times. So we will start out with Paul, and we are all very interested in hearing from him. Thanks.
Thank you, Wolfgang. We're going to talk about something that we decided to put the label on residual profit allocation proposal. It's a concept that we've been thinking about. It's not ready for prime time yet, I would say, but as a concept, we felt it was worth exploring with you all and with others, and to see what kinds of suggestions and improvements could be made to it. So it's really an exploration more than, I would say, an endorsement by the group. It raises many questions that we'll raise, and unfortunately we don't have all the answers, at least yet, but so any assistance in that respect would be most appreciated. From my own perspective as a practitioner, I became interested in kind of what was beyond BEPS as I saw and understood where BEPS was likely to go and where it did go with the, if you will, alignment of value with functions, which makes me cringe a little bit. I've spent 30 years in private practice helping companies with their international tax planning, and in the course of that have seen from my US multinational clients a hollowing out of US manufacturing, obviously not only because of tax, but it's happened, and tax has been a willing factor in that, and I think an important factor in that. And if we now are in a world where you have to have, as tax practitioners now call it, DEMPI functions, DEMPI being developing intangibles, enhancing intangibles, maintaining intangibles, P is protecting intangibles, and then exploiting intangibles. Ian is helping me here remember all the words behind the acronym. If you have to have sufficient of those activities in the jurisdiction where you're paying, you know, an Irish 12% tax rate, or if Ireland is still willing, a 2% tax rate, then those people are going to move, at least some of them. And in fact, as a practitioner, I'm already dealing with the question of who's going to go and how many. And so that is not going to be a happy development in my judgment, looking at it from kind of a micro level and then thinking about the macro implications of that. The irony is that from a US perspective, none of this really matters because the OECD guidelines are not part of our laws in the United States. They're just a document that's out there that people refer to from time to time. The sole exception, I believe, is the US-Japan Treaty, which actually incorporates the OECD guidelines in transfer pricing disputes between the two countries. But other than that, we don't have them. But we're still getting into arguments. For example, if you take the paradigm situation of a US multinational that manufactures in Ireland and sells in Germany and doesn't have a lot of the DEMPI functions in Ireland with its manufacturing. It has the manufacturing people, but not necessarily the people managing the technology. If Germany raises transfer pricing issues based on the lack of that substance in Ireland, the first answer is that's none of your business. That's between Ireland and the United States. Those people are in the United States. They're not in Germany, so you shouldn't, under the OECD guidelines, be able to allocate any of that income to yourself. The problem is you want the Irish to be able to make that argument for you in competent authority disputes between the Germans and the Irish. And the sense is, at least, that if you're relying on, say, Irish competent authority or the UK competent authority or any of the competent authorities where OECD guidelines are the law, they're going to feel a lot more comfortable making that argument if you actually have those functions in the local jurisdiction. So even though from a US perspective, the DEMPI requirements aren't important, the United States is not going to grab that Irish income if you have DEMPI functions in the US. It's still a very big concern to US multinationals already that they're going to need to move more activities into jurisdictions in order to justify their tax rates. So the question is, okay, if that's going to be an unsatisfactory endpoint, what could we do to reduce factor mobility? And as Mike Devereaux and others in the first panel discussed, part of that is looking at more fundamental reform like the destination-based cash flow tax. But we also wanted to think about something that was more incremental, something that might build more off the existing system. And that's what the residual profit allocation proposal is. The core idea is to take the classic tax planning model of today, the entrepreneurial model, as many people call it, which divides the world of allocating income into two buckets. One is routine returns, let's call it, and that's what most people call it, which means kind of a cost plus markup for a services activity, maybe a rate of return for manufacturing activity if there's substantial capital investment. But it's routine in the sense that what you're looking to judge it against in transfer pricing terms is the activities of independent companies that are not multinationals necessarily, that are in a limited business, that aren't taking entrepreneurial risk with respect to the products that you're manufacturing. Rather, they're providing a service to that activity or some other specific function to that activity and earning a return on that. So it's like a lawyer would be, for example. We would be a routine return, and proud of it, by the way, to those kinds of activities. And similarly with, say, clinical testing firms in the pharmaceutical industry, they earn, you can observe their routine returns. So the idea is to put that on the one hand, and then the remaining return is what we call the residual return. And that is the entrepreneurial return, because the cost plus return or the return on asset sort of return are pretty consistent over time. The residual return measures the success and failures of the business. That's the model that most multinationals use today when they're attempting to minimize their tax rate. And they use it by putting the entrepreneur in Ireland or Switzerland or Luxembourg or Singapore or Puerto Rico or the UK, one of those jurisdictions that has a reasonably favorable, the Netherlands, so a favorable tax rate and other arrangements. And they do that, of course, by their own choosing, not by operation of rules. So the thought was maybe we could turn that on its head somewhat and say, okay, let's give a routine return to functions and activities, just as multinationals often voluntarily do today. But let's mandate that the residual return should go to the market jurisdiction, the jurisdiction where, if we're talking about the sale of products, the product is ultimately sold to a third-party user. And the way the system would then work is that you would, if you have goods that flow across borders, you would build up a transfer price based solely on routine returns. And then the price coming into the market would reflect just the costs that went into the product plus the routine returns allocable to that product on a separate accounting basis. This is not, at this point, an apportionment like CCCTB or anything else would be. It is a separate accounting based on the functions that have been incorporated in that product, the cost of goods sold related to that product. And that determines essentially the price coming into the market country, and then you take the expenses in the market country and the revenues of the market country, and that gives you the residual profit. So it is a mechanism to say that the entrepreneurial return should be in the market rather than in a tax-favored jurisdiction. Why does that make sense? Well, it seemed to us there were several reasons why it makes sense. The first is the reason was talked about in the first panel, is factor mobility. There's a sense, certainly in our group, and I think with many others, that the market is the least mobile factor in many economic activities, and that if you can determine with clarity what the market jurisdiction is, then you've got a fairly stable system. I think that raises some questions rather with capital goods sellers and with component sellers or intermediate product sellers, because they're selling to businesses rather than to consumers, and the businesses that they're selling to are more mobile than are the consumers. And we'll talk about this later, but you do have to worry about factor mobility in those sectors resulting from this kind of system, because, for example, just to take an example, if Intel is selling chips to say Hewlett-Packard, if Hewlett-Packard manufactures its product in Singapore rather than in Palo Alto, Intel will have a lower tax rate because the market for Intel would be Singapore, and there's no way that you could, we would think you could actually trace where those chips went in the Hewlett-Packard product. And so would that encourage Hewlett-Packard to invest more in a Singapore operation than a Palo Alto operation because maybe they could get some better pricing from Intel? That's clearly an area where more work needs to be done in all of the proposals that are talking about allocating income to market jurisdictions and factor mobility as a rationale for it. But I think in the traditional world of income taxes, there are a couple of other reasons why this proposal isn't so radical. One is something that I've observed in practice for a long time, reflecting a difference between the way valuation people think about value and transfer pricing folks think about value. When you see a valuation like a purchase price allocation exercise that's done when one company buys another, you almost always see a huge portion of the intangible value allocated to things like customer relations or existing customer base, and goodwill. Goodwill defined being the potential of future business from existing customers and new customers, and less value being allocated to things like patents and trademarks and, if you will, hard intangibles. And what does that tell you from a transfer pricing point of view? In my judgment, there's been something of a disconnect in that in transfer pricing planning, because to me, the goodwill, the customer relations, the installed base type intangible really adheres to where the customers are and not anywhere else. At least it's as logical as anything, if not more logical, to have it adhere to where the customers are. If you have an HP printer and you're using their ink because you have HP printers, that's an installed customer base that gives HP a real advantage in making money on its ink off of your customer base. And there's no reason to say that that should be a US intangible if you're located in Germany. It seems to me logically that's a German intangible. So the world of customer-based intangibles gives a rationale for allocating a substantial part of, if you will, residual value, which usually reflects intangible value, to the market country. The second is really going back to our traditional source notions, because even with statutory intangibles like patents, copyrights, and trademarks, the source rule that's used around the world is that it's sourced in the jurisdiction where the intangible is used. And that means the jurisdiction that is protecting it with respect to the sale to the customer, typically, not the jurisdiction where the intangible was created, or even necessarily the jurisdiction where the intangible was reduced to a manufactured product. If you're a pharmaceutical company and you have a patented drug, what you really care about is the patent law in the jurisdiction where you're selling it to a customer, because if they're not protecting your patents, you're not going to make any money in that market. Similarly, if you're a handbag manufacturer and trademarks aren't protected in a particular jurisdiction, you're going to make a lot less money out of your trademarks. And our source rules in income taxation have long recognized that. Now, it's been a source rule, not a transfer pricing rule, and there's a difference between them, because the source rule would say, okay, if I'm a French company and I own the trademark right to a handbag and I'm selling it into Austria, let's say, then it may be that with respect to the use of the trademark, some of the income should be sourced in Austria, but it's still income of the French company. And it's very difficult for that to work from a tax perspective historically, where physical presence is important. And so our system has developed in a way that is basically ceded jurisdiction of taxing that value from the jurisdiction of source back to the jurisdiction of residence. And what we're talking about here is essentially a mechanism to reverse courses on that, to say, no, the market jurisdiction in traditional income tax principles does have a right to that income, because after all, it's its laws that are protecting it. And so by coming up with this allocation mechanism of allocating residual profit to the market jurisdiction, we are really just resurrecting the vitality of that source rule and building it in to transfer pricing. The next element of it that we need to discuss is, well, that's all fine to have residual profits be taxed in the market jurisdiction, but what about all the expenses? What about all the expenses that are not specific to the product? We understand that the cost of manufacturing, the cost of distributing, maybe the cost of services that relate directly to the product would be rewarded on a routine profit basis, building up the transfer price going into the market country. But there are expenses that are not built into cost of goods sold or otherwise directly related to the product. They're typically what accountants call below the line costs. And that the principal ones of those are R&D, G&A, sales and marketing, and interest. And so we spent a fair amount of time actually talking about each of those, and there's different ways you could treat these costs. So there's no magic in our thinking on that, but it did seem that the jurisdiction where those activities that give rise to those costs are performed should get some income allocation, if you will, as a result of that. So that R&D, for example, should be, the performance of R&D should be rewarded on a cost plus basis. And again, you can find in transfer pricing third-party service providers who provide R&D services that you could use as a model to determine what kind of charge you would make, and that charge should be borne directly by the market jurisdiction, okay? So that you would in effect have a service payment that was being made by the market jurisdiction back to the R&D performer, and you would come up with an allocation mechanism. Maybe you would do it based on revenues, maybe you would do it based on sort of a notion of gross income, but you would essentially apportion your R&D expense over the various market jurisdictions based on one of those formulary methods. And in fact, this is adopting something for these costs that is closer to formulary apportionment than the separate accounting that we're talking about for the basic costs that are tied to the goods or services in question. Similarly, with sales and marketing, you can kind of divide them into two buckets, one being the product-specific sales and marketing, which should be attached to the product and follow it. Some of those costs may be loaded into cost of goods, and if they're not, you can still attribute them directly to the product, or at least to a subset of products, and then spread them out over that. But to the extent you have broader sales and marketing costs, those costs should be marked up so that the jurisdiction where those activities are performed get some income subject to tax in those jurisdictions, with the then marked up costs spread out over the market jurisdictions, again on some apportionment basis, whether we're talking about sales or gross income or something else. Similarly with G&A, and in fact, this is one of the things that today I've been really disappointed that circumstances like BEPS haven't focused on, because today most multinationals can only charge out a modest portion of their G&A expense, given that under the arm's length standard as incorporated in the OECD guidelines and in the United States in our own regulations, says that you can charge out G&A costs if they are a cost that directly benefit the foreign affiliate such that they would pay for it were they an independent company. And with so many G&A costs, you can't meet that standard. And you certainly have a lot of difficulty persuading foreign governments that you do meet that standard. So it's an area where you look at multinationals, it's a cost that's disproportionately borne by their home jurisdiction, because that tends to be where the G&A is. And it's one of the reasons why I think most multinationals pay relatively less tax, say, per dollar of revenue to their home jurisdiction than what they pay to other jurisdictions, because the G&A costs are largely borne in that jurisdiction. Seemed to us that's not a necessary or even a preferable answer, and that charging out G&A to the market jurisdictions, again with the markup, so that the jurisdiction where the G&A is performed gets some, cost plus 10 or cost plus 6, whatever might be appropriate, would make sense. So that you would have these indirect costs, and it would be a direct charge. It would not be built into the transfer price of a product. It would be that the market jurisdiction would end up actually, getting a bill from the country where the G&A is performed, and you would have to show the local tax authorities how you computed the G&A that's attributable to that country, rather as opposed to other countries. And again, it would be more or less of a formulary method for allocating the G&A. Finally, interest expense. BEPS spent a lot of time in Action 4 on interest expense, and the first road they crossed was to say, we can't come up with a system that automatically allocates third-party interest expense to various affiliates, because countries who weren't going to have third-party interest expense incurred in their jurisdiction didn't want to give a deduction that didn't reflect an actual expense in that jurisdiction. And third-party interest expense tends to be housed in the parent country or in a country with a finance company. So it's housed in one place and then spread out through related party debt and other mechanisms. That tends to be the pattern of multinational organization. And so having a system that directly allocates the third-party expense and ignores the intercompany expense was a step that the BEPS participants were just not willing to take. It would encompass giving deductions where there was no actual expense on the local P&L in some cases. In our thinking about this, since charge outs for G&A and charge outs for R&D are already part of the system, there's no reason why you can't do that with interest as well, and essentially disregard all intercompany interest and apportion the group's third-party interest around to various jurisdictions. And with interest, it might be appropriate to apportion it to include the jurisdictions where you're just earning routine returns and not allocating it all to where you have residual returns. In fact, I think many folks would think that's entirely appropriate. So you might apportion it, if you will, based on some notion of the EBITDA or income of all the affiliates around the group. So that's the core concept. It is separate accounting on a routine profit basis for the costs that relate to the specific product or service that's generating third-party revenues, and building up a transfer price for that in the market jurisdiction, coming up with kind of, if you will, the gross income number based on the revenues that are actually earned in that jurisdiction, and then apportioning the corporate-wide expenses, G&A, global marketing, interest, R&D, to those jurisdictions on some sort of formulary basis. Now, this sounds fairly formulary, but it's really quite different than a formulary apportionment based on sales, even though we do end up with quite a bit of income in the jurisdiction of the market. First of all, we are allocating routine returns to functions and activities. And so what we're talking about is just, if you will, spreading the residual profit to those jurisdictions, not the entire profit. Now, you could do that with formulary apportionment. I think, in fact, some of Reuben's versions have suggested that you just look at excess or residual profit. But the difference with that is that by doing separate accounting, you are taking into account in a jurisdiction its own revenues and its own related expenses rather than an average of the group's expenses. So that if you have a jurisdiction, for example, the United States with pharmaceutical products, where the United States allows higher revenues per unit than does, say, Germany or many other countries, that would lead to more profit being taxed in the United States under this proposal than it would be under formulary apportionment, where the product profits are basically averaged over all of the jurisdictions. Here, because you're doing separate accounting, you end up with a more specifically identifiable product in the profit rather in the jurisdiction than what you would achieve under formulary apportionment. And we think that's entirely appropriate. If it's a jurisdiction, for example, that doesn't provide patent protection, so that on a factual basis your profit in that jurisdiction is low, why should that jurisdiction get the benefit of the higher profits in some other jurisdiction because of the formulary apportionment of a broader concept of income? And we think the price that you would pay for it, which is the price of having to do the separate accounting and having to calculate the, if you will, routine returns that are obtained by the functions in the process of building up the price, are worth it. They're worth it both because that's what people do today, so it's not as radical a change in the system, and because those build-ups, if you will, achieving a cost plus or a return on assets, do not generate large controversies. And if they do start generating large controversies, maybe you could come up with safe harbors or other mechanisms to try to mitigate those controversies without going all the way to formulary apportionment. So what would you accomplish from a factor mobility perspective? Well, if we're right that the market is the least mobile factor and that the capital goods and intermediate goods issues are not that much of a concern, then you've accomplished a fair amount by having the residual profit now be off the table in terms of factor mobility. Because if you, for example, could move your factory from Columbus, Ohio to Cork, Ireland, and get a substantially lower rate if the return you're going to get on that is, say, cost plus 10. And so just think of a situation where your revenues would be 100 and your costs would be 90 and your profits is 10. That's a little more than cost plus 10, but think about it that way because the math is simple. Moving from a 35% tax rate to a 12% tax rate is basically going to save you $2.25 per in an operation per 100 in an operation that has $90 of cost. Well, the incentive to move that $90 of cost to save $2.25% of profits is not very large because unless the cost savings themselves determine the move. So our view is that by identifying routine profits with functions and activities, you can minimize factor mobility because the rewards of the mobility just aren't that large. Several issues that are part of this that really need to be focused on before one can say that this is a viable system. The first is, and this was talked about earlier, the location of sales. It's much easier to do business remotely these days. The system is going to have to take that into account and pierce through it. So, for example, if pharmaceutical companies start selling to McKesson, who's a big distributor in the United States, in Ireland instead of in the United States, that can't make the location of the sale Ireland. You're going to have McKesson report to the pharmaceutical companies about where they sell their product in order to get a realistic view of the market. And I think you're going to have to do that with distributors generally. Now, in my experience, which is purely anecdotal, not at all systematic, that's not necessarily going to require a lot of information that's not generated today, because when companies sell through third-party distributors, not just in pharma where there are regulatory issues, but in businesses generally, they want to know where those distributors are selling. And they want to minimize the extent to which their distributors are selling in jurisdictions other than where they're supposed to be selling because of the differential pricing that companies have in different jurisdictions. And so the judgment, at least preliminarily, is it's probably not going to be too burdensome on companies to require them to get from their wholesaler or other third-party distribution purchasers the jurisdictions in which their goods were sold. The second element that's going to have to be dealt with is obviously a broader definition of permanent establishment is going to be required effectively because remote sellers are going to have to pay tax in the market jurisdiction, whether they have a physical presence there or not. OECD didn't go that far. The diverted profits tax goes that far, but only in circumstances where there's an affiliate that does business in this country. This would essentially take a diverted profits tax approach as a general rule, but would not have the limitation about having some other affiliate with a presence in that jurisdiction. And that's something on which it seems to me a lot more thought needs to be given to. Another point is that natural resources would need to be carved out of this because I think it's difficult, and in our group certainly viewed as difficult to see that natural resource jurisdictions would end up getting only a cost-plus return on the exploitation of their limited resources, so you'd have to define what that is. Another area, which is what Reuven mentioned earlier, is the treatment of services. That's going to be one of the toughest tasks to deal with. It's true, you have the same task with the destination-based cash flow tax. You have the same issue with sales-based apportionment taxes and the treatment of services, who the customer is, and how you create a presence for the service provider in the service recipient jurisdiction is a challenge that will have to be faced. The treatment of losses is an issue because we're talking about residual profits here after the charge out of expenses. And so there are definitely going to be cases where there are residual losses. How do you deal with those? We have some thoughts on that, but that requires further work and maybe modeling. One of the good things is that I think in our judgment, this kind of proposal would be consistent with GATT because it would essentially be a variation on transfer pricing and not a consumption tax, and it would be treating imports and exports the same from a jurisdiction point of view. You would just be getting a routine return on your functions, and you would be getting a residual return on activities that involve your own consumers. So I think our view, as Wolfgang can comment further on it, is that it would probably be consistent with GATT. It is a proposal that might be of more interest to the United States than to some other countries, partly because we don't have a VAT, as was mentioned before, and partly because we have a lot of imported products relative to our exported products, and so and also we have a lot of G&A that could actually be getting a markup. So I think from a U.S. perspective, it might be somewhat more interesting to do on a unilateral basis. The United States could do something like this, and it would override our tax treaties, but we are allowed to override tax treaties by legislation. So if it were to get started, it might have it start in the U.S. and then renegotiating tax treaties put pressure to spread elsewhere, which is, of course, what happened back in the 1960s with arm's length pricing. That's it.